10-year Treasury yield hitting its highest level since May. This ahead of the Fed's rate hike decision tomorrow. Joining us to discuss where bond yields go from here, Fred Lane from Lane Generational of Raymond James is here at Post 9. And Peter Boockvar joins us, CNBC contributor from Bleakley Advisory Group. Peter, not just the 10-year, 30-year at 324, highest level since May. How does this setup look into the Fed for the bond market with these rising global yields?
Well, it's interesting because what's happened over the past couple of weeks is the curve started to steepen a bit as the 10-year broke through 3 and now is approaching this key 311 level. The Fed's going to keep on raising interest rates on the short end, which I think was one of the factors in flattening the curve. But now we're seeing rising inflation expectations, nominal GDP, which with some estimates approaching 6%. You have the Fed about to ramp up quantitative tightening in Q4. The ECB is about to end QE. The Bank of Japan is letting long-term rates rise. We've had pension fund buying that was pulled forward before a deadline September 15th for them to apply for a higher deduction. So I think a combination of good and not so good factors leading to this steepening. But either way, rates are going up across the curve.
Fred, do you agree that this slight steepening we've seen in the last week to 2 weeks gives the Fed a little bit more cover to hike rates? Is this week a lock, and how many do you expect for this year?
I think it is a lock, and I expect one more after this. But I'm not a big believer that we're going to have a 4-year, 10-year within the next 12 months. I just don't see it. I see too many deflationary pressures. I don't see huge wage growth. We have full employment. There are a lot of interests here who do not want interest rates to go a lot higher, and I don't think they're going to go a lot higher, particularly at the far end of the curve. Deflationary
forces? Are you talking technology?
Yes, exactly.
Peter, do you agree with that call that the 10-year can't go up to 4%, that this might be it when it comes to rising rates for the year?
I mean, before we get to 4, I think we're going to get to 3.25, 3.5 by the first quarter of next year. And the deflationary forces, I mean, since the history of time, we've had deflationary forces with regards to technology. We've had inflation in cyclical cases. So right now with tariffs, I see faster wage growth than Fred does. I think we're seeing it pretty much across the board. And I think the Fed is responding to that by talking about, at least Brainerd and Williams, that they don't mind getting close to a flat yield curve or maybe even inverting it. And they're going to keep on raising short-term interest rates. I think the biggest factor on the long end is how are bonds going to respond when the ECB ends QE. As I mentioned, the Fed's ramping up QT and the Bank of Japan is pulling back. Because I have to believe that the German 10-year is not going to be sitting here at 50-odd basis points next year when the ECB is completely done with QE.
Fred, whether or not we get to 4%, if rates are going to continue to rise in the next 6 months or so, is that a reason to buy the banks that have pulled back recently or not?
I don't think it's a reason to buy the banks. I think the banks are so constrained by regulation. It is not the same banking industry that it was 20 years ago when I was at Donaldson, Lufkin and Jenrette, nor 10 years ago. It's a very different world today. The fun of it's frankly been taken out of it, and there's a lot of capital out there. So I think
even with the Trump administration working to roll back some of that post-crisis regulation?
I'll believe that when it happens. I think it will happen, but I don't think it'll happen. It's not going to change the universe in terms of the earnings power of the banks going forward, in my opinion.
Peter, I just want to come back to your comments there on German yields, on the ECB ending of QE. I haven't caught up with you in a while. Are you still bearish in terms of how hard the Eurozone economy will be hit when QE is ended in a way that perhaps the US economy wasn't hit when it ended here?
Well, I'm not as certain about how the European economy responds. I'm pretty confident that European rates are going to rise, which will obviously impact growth, but I'm uncertain to what extent. I'm most worried about the European bond market and how it responds. We've already seen a rise in yields in the corporate land in Europe. And my correlation, the reason why I brought up the German Bund, is because if the German Bund goes closer to 1%, you can believe that the U.S. 10-year is going to be heading higher as well in yield.
Very quickly, Peter, so rate hike baked in the cake tomorrow. What will you be listening for in the news conference, or what kind of language will you be watching out for in the statement?
I want to see whether he leans to a December hike. Now, he doesn't necessarily have to because he's got time between tomorrow and that December meeting. But will he bring forward a 2019 hike into December? I think that's really going to be the key in listening to his body language and whether he's going to be explicit in leading in one direction or another.
And Fred, you expect it in December?
I do expect it, yes.